$10 per day or $300 per month doesn't sound like a lot of money, but it's actually a life-changing amount of money, which we are going to talk about in this video. You see, the concept of compounding is a beautiful force that allows small investments to grow significantly as long as they're invested over a long period of time. This is referring to the process of earning returns not only on the initial investment, but also the accumulated earnings or dividends along the way. When you make an investment such as buying stocks, bonds, or mutual funds, you then have the potential to earn a return on that investment. Let's go over and consider a few examples. Suppose you invest $1,000 in a stock that has an average return of 8%. At the end of the first year, your investment will grow to $1,080, which is the original investment plus the 8% return. Now, instead of withdrawing the earnings, you reinvest the entire amount, and this is including the $80 in profit back into the stock. So in the second year, your investment would be $1,080 with the same 8% return, and you would earn $86.40, resulting in a total investment of $1,066.40 at the end of just the second year. Again, next, you would reinvest the entire amount, including all the earnings up until this point. Now, as you can see, the process continues with your investment growing each year due to the compounding effect. And what the cool thing is that over time, the compounding effect becomes more pronounced and accelerates the growth of your investment. For example, let's fast forward to the 10th year. Your original investment of $1,000, compounded at an 8% annual return, would grow to approximately $2,160. And while the returns in the early years may not seem significant, the compounding effect becomes substantial. Now, what's crazy is that if you continue to do this, or if an investor does this over a period of 30 or 40 years, the growth becomes insane. And stay tuned because I'm going to show you. Because due to the power of compounding, the initial investment can potentially multiply times and times over again. But what's important is that the key to benefiting from the power of compounding is to start early as possible and remain consistent with your overall investment approach. Because by giving your investments time to compound, you can potentially generate substantial wealth, even with a small initial investment. But now, like the title of the video says, let's see what the power of compounding can do with just $10 per day invested into the S&P 500. So this right here is ticker symbol SPY, better known as the S&P 500 ETF Trust. Now, as I'm sure a lot of you already know, the S&P 500 is made up of around 500 of the best and highest quality companies. The top 10 companies in the S&P 500 say it all. Number 1 being Apple, 2 Microsoft, Amazon's next, Nvidia, Tesla, Alphabet, Meta, Alphabet, Berkshire Hathaway, and United Health Group. Now, if we were to try to figure out what the S&P 500's average annual return is, this says that the historical average yearly return for the S&P 500 is around 10.05% over the last 20 years. And as of the end of April 2023, this assumes dividends are reinvested. Adjusted for inflation, the 20-year average stock market return, including dividends, is around 7.33%, or let's round up to just 8%. With just a $300 starting principal and just $3,600 per year, which is around $10 per day or around $300 per month, a dividend tax rate of 15%, a 1.5% annual dividend yield, which is somewhere around where the S&P 500 is offering right now, a 3% expected annual dividend amount increase, an annual share price appreciation of around 12%, and we have 30 years invested. Let's see exactly what we get. So for year number 1, this investor would have a $300 investment into the S&P 500. And again, keep in mind this investor would already be earning around a few dollars per year in dividends. Now the next year, after the just $10 per day investment into the S&P 500, this investor would have a portfolio of around $4,000 with around $54 per year in dividends. By year number 3, this investor would already have $8,000 plus in principal with over $100 in annual dividends. Now, what's important to keep in mind as we go down this list is you're going to see the power of compounding really kick in because, again, remember, this investor is taking all the dividends, adding it back into buying more shares of the S&P 500, as well as on top of that, spending an extra $10 a day as time goes on. By year number 5, this investor would have over $17,000 and around $200 a year in dividends. Skipping ahead by year number 10, just 10 years invested, around $10 per day, this investor would have almost $56,000 in principal and almost $400 per year in dividends. By year number 15, this investor would have $124,000 and around $576 per year in dividends. By year number 20, this investor would have almost $250,000 invested into the S&P 500 with almost $750 per year in dividends. By year number 25, $458,000, almost $1,000 in dividends. And by year number 30, this investor would have around $800,000 or so, with over $1,000 a year in dividends. And again, what's substantial is that this portfolio was built off of a tiny, little small initial investment and just $10 per day invested into something like the S&P 500. Now, the biggest takeaway that I want you to have from this video is the importance of starting early. I started my investing journey a little bit late, honestly. I started in my 20s and wish I would have started around 10 years earlier when I first got a job and first started making some money. And again, the important part is that you don't need to invest all that much money to see substantial growth as long as you have time on your side. Because the most important part, as we talked about, is harnessing the power of compound interest. Compound interest is often referred to as the eighth wonder of the world by renowned physicist Albert Einstein. And although the concept is simple, as you saw by the dividend calculator, an investor that has time on their side can input a small amount of money consistently and see massive returns over time. The other thing that I didn't mention yet, the coolest thing about this altogether, is the fact that the annual contribution amount can change, of course, due to your certain situation. Let's say an investor had even more to contribute on a yearly basis, or maybe an investor had less to contribute. The thing that's important to know is that the math is the math. And obviously, if an investor has more to contribute, they're of course going to see larger and larger numbers when it comes to the compounding. But what I recommend all you to do is hop on a dividend calculator online. They're mostly all free to use, and plug in, type in some different numbers, and try to set up your own goal and strategy for the long term. If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks again for stopping by, guys, and I'll see you in the next one.